Hello and welcome back to Game of Trades, your number one channel for videos on the stock market and cryptocurrencies. So this has been an extremely tough market environment, lots of swings, very powerful up and down on the market. 11% moves up, 10% move down, lots of whipsaws in either direction. In fact, pretty much flat since May of 2022. But if you add some key moving averages on this chart, you can see they're all clustered together here. That usually means, from a technical analysis standpoint, this tends to mean there's a big move that's not too far ahead. I can show you a few examples of that in 2015 cluster here right before a massive breakdown. Same thing here in December of 2007. The cluster of moving averages right here, flat price action before a massive move down, the real beginning of the 2007 bear market. And on the other hand, you have situations like here in 2006 where the cluster of moving averages ended up playing for an upside move. So there's a lot of debate regarding what's going to be driving the next big move in the market and in which direction it's actually going to go. If you've been staying up to date on the recent US central bank news, you'll know that the Federal Reserve is responding to the banking crisis with a much more dovish tone, meaning they tightened by 25 basis points in the last meeting instead of 50, and they even hinted at pausing their hiking cycle after this 25 basis point hike. Now, the Fed is what drove the market down in 2022, so a very simplistic outlook on the market would suggest that if the Fed starts to become more dovish, we can expect stocks to rise significantly in the months ahead, a little bit like what happened in 2019. Right here, you can see I add the federal funds rate on top. You can see the exact moment that they paused their hiking cycle. Right here, the market was moving down towards the end of the hiking cycle as you had troubles in the repo market. The Fed paused, and look at what happened to the market. It bottomed, made a V-shaped recovery, and started moving higher in the year ahead. So perhaps there's a little bit of recency bias that's playing here, where investors are essentially expecting a similar thing to happen this time around. Rinse, wash, repeat, Fed pause, stocks go up. So in this video, I'm going to show you why the banking crisis that we've had over the past few weeks, why it's very unlikely that it actually ends up being a positive for the market, because that's why monetary policy could pause in the next meeting because of the banking crisis. I'm going to show you why that's not going to be a net positive for the market. We're going to talk about the idea that the trouble we're having in the banking sector actually significantly outweighs any pivot that you might see from the Federal Reserve, and also all the other impacts that we are currently seeing materialize in the economy right now just from this hiking cycle. And I'm not just talking about the banking crisis that we've had over the past few weeks. There's a lot of other things going on underneath the surface. So without further ado, let's get right into it. And don't forget to smash that like button as hard as you can. Now, I'm going to quote a few different research firms in this video. Now, we do produce our own research at gameoftrades.net, but it's always very insightful to look at what type of work other research firms are doing. And this one in particular, Apollo Research, came to the conclusion that the recent banking crisis actually corresponds to a 1.5% increase in the federal funds rate. So even though the Fed did a 25 basis point hike instead of a 50, and they're suggesting that they might pause their hiking cycle, if you actually take into account the tighter lending standards that are going to materialize following the banking crisis, and this is something we've been talking about over the past few videos. If you've been paying attention, you'll know that the banking crisis is leading banks to tighten their lending standards, which is basically the equivalent of the Federal Reserve raising their target rate. And so this research firm actually came to the conclusion that it corresponds to a 1.5% increase. So taking us to the equivalent in a very short amount of time to 6.5%. So if you're wondering why the infamous Fed pivot that everyone has been waiting for is not leading to a big melt up, despite the fact that the Fed actually announced it last meeting. Obviously, they didn't talk about rate cuts because that would just be too much of a shift in their tone, but it was indeed a dramatic reversal in their stance, and for the first time really being open to a pause in their hiking cycle. Well, the reason that didn't happen is because the market knows that the Fed pivoting on monetary policy because of the hiking cycle is actually not such a good thing, because financial conditions have actually tightened, not loosened, since the SVB collapse. And another chart that shows this very well is the Bloomberg Financial Conditions Index, that has also shown a significant tightening in those conditions very rapidly. Now, it doesn't have necessarily much predictive value, but you can see leading up into recessions, that's something that you typically see a lot of, and to a big extent, you see a big tightening of financial conditions in 2000, 2001, 2007. But the question is this it? And we're going to see a V-shaped recovery like 2019, or is it going to get worse? And financial conditions are actually going to get worse from here. Now, this brings me to another study that I want to quote here that was published on the 24th of March regarding the fragility of the US banking sector. There are some key points that are very important to understand. Uninsured depositors stand to lose part of their deposits if the banks fail. That gives them incentives to run. Now, if you remember, one of the key reasons why SVB actually failed, it was because of the enormous unrecognized losses that SVB actually had, which then led to liquidity issues and ultimately the bank run. And look at what they say here. 10% of banks have larger unrecognized losses than those at SVB. Now, a big part of what fueled this is indeed the historical tightening that we've had throughout 2022, a very aggressive tightening cycle that led bond prices across the board down, and the financial system that is leveraged long on bonds is experiencing a massive amount of losses as a result of this tightening. Now, in addition to that, you've also got the fact that depositors are leaving banks to get a better yield in money market funds. And this is something we've talked about in previous videos, that the rate you're getting for having your money at the bank is much, much lower than a rate you might get in a money market fund. So you're seeing an exodus of money out of the banking system and into money market funds, something we showed a few charts on over the past couple of videos. Now, the study does say that SVB had a disproportional number of uninsured funding. And we know that's true, right? SVB was among the banks, was definitely in the top number of banks in terms of the number of uninsured share of customer deposits, which is really the reason why it was the first victim, and you had SBNY follow not too far behind. But what the study concludes is essentially that if you take into account these losses and the uninsured leverage, we see that there's similar incentives for an SVB-like depositor run. If only half of the depositors decided to withdraw, almost 190 banks would be at risk of impairment. So these massive unrealized bank losses have significantly increased the fragility of the US banking system, something that makes a lot of sense. So if there's more bank runs, like this study would suggest, then you would have even further tightening of lending standards, even if the Fed funds actually goes down and the Fed actually pivots. And this is something we actually saw very clearly in 2008. You can see the Federal Reserve, the Fed funds rate in red here, was going down throughout the financial crisis, but lending standards in blue right here, you can see that was going up as banks were failing and tightening their lending standards because it was a very risky macro environment. And so despite the fact that the Fed was easing, you still had a tightening of financial conditions throughout the financial crisis because of the banking crisis. Again, I'm not saying this is exactly what's going to happen this time around, but I'm proving out the point why the SVB collapse is not a net positive for stocks, even though the Fed seems to be adopting a more dovish tone and possibly pausing their hiking cycle. Now, of course, this is a developing situation and we've had lots of volatility around. If over the next few weeks we see concerns around the banking crisis diminish and the Fed also really adopts a more dovish tone, well, you could see stocks move higher. But we ultimately think, and we're betting on that at GameOfTrades.net, that any rally would likely to prove very short-lived because a recession is going to start getting more and more priced in by the market. If you look at this chart right here, and this is from the Small Business Survey, this is a question that asks small businesses if credit was harder to get than last time. That's a big warning signal, right? If credit is harder to get, that increases the odds of default. So this is a great way of seeing whether that's actually being felt by small businesses. And you can see systematically, you see that credit is harder to get leading up into a recession. right? Whether that is because the Federal Reserve is hiking, or it's because banks are scared of the current macro environment and so they're not willing to lend money anymore. You can see systematically leading up to recessions, you have a rise in the number of businesses that say that credit was harder to get than the previous time. And of course, we see that's something that's happening right now. So the tightening of the lending standards ever since around mid-2022, they've really begun trending higher, which has systematically, again, timed recessions. These gray bars, you can see those are recessions. Look at what happens to the red line here, the moving average leading up to recessions. It's curling up very violently into that recession, curling up into that recession, curling up into that recession. We recently just closed our Bitcoin position on our model portfolio. We initially included Bitcoin at $19,000. That's when we added it. We closed it at $28,000, so almost a 50% return in 90 days. We're incredibly happy about that because that is the goal that we have with the model portfolio, is to be successful, to outperform the market, and to take you guys along on that journey. And of course, give you that notification as soon as we make any changes to the portfolio. We're currently positioned for a recessionary macro environment. We intend on growing our portfolio despite tough economic conditions. If you can grow your capital during a recession, if you can grow your capital during market volatility and buy when stocks are cheaper, that's what can make the trade of a lifetime. So grab yourself a free trial if you're interested in that type of service. Now that's about all I wanted to cover in this episode. I hope you guys enjoyed. If you did, make sure to smash the like button and click on that subscribe button if you haven't already. Now in the meantime, I wish you good luck on your trading and see you next time.